Hello and welcome to the DIY Investing YouTube channel. We are working through every company in the S&P 500, and today is Cerner Corporation, ticker CERN. Over the next few minutes, I'll discuss my thoughts on both the valuation of this company and its business quality. First thing we want to look at is the market cap. We have a $27.9 billion market cap, $28.6 billion enterprise value. There's a very small amount of leverage here, about $700 million, which is relatively small on this size. This is in the healthcare technology industry. Let's see if we can learn a little bit more about what they do from the business description. So they offer healthcare information technology solutions and tech-enabled services. They have the Cerner Millennium Architecture, Person Computing Framework, health records, cloud-based platform, aggregate, transform, reconcile data. So it gives you some idea. They are basically technology for the healthcare field. Some useful information. Now, this is actually really interesting. The first thing we see from this return on invested capital chart is you have 20 straight years of profitability. There's not a single loss. Now, when you see that, that's the first sign that this is a relatively high quality company. Immediately, my eyes are also drawn to this gross profit number. 82% gross profit margins are very, very high. Another sign of a high quality company. I'm liking what I see here. Now, the second thing we see is we can see kind of a general trend of improvement from 2002 up until a high of like 2017. The business seems to be getting a little bit better returns over time. But since 2017, we've had maybe either a cyclical downturn or some sort of deterioration in the business. But overall, still pretty good returns. What I like to see is this 10% line for return on invested capital. A lot of the time, you're above that line. But even when you're not, you're relatively close. 9.8% in 2019, 9.8% in 2021, 9.4% 2004. But those years are almost so far back that it doesn't matter. But basically, from 2005 all the way through 2021, you're earning at least a 10% return on invested capital. That meets my hurdle for another high-quality company metric. What I also like to see is when I go to these 10-year median returns, I'm seeing that the return on equity is hitting this 15% mark. That's my threshold. What I like to see is I want to see double-digit numbers for return on invested capital and 15% plus for return on equity. It looks like the little bit of debt that this business is using is allowing them to boost their return on equity above 15%, which is your sweet spot for getting that very strong return for shareholders. If you want to earn a 10% return as a shareholder, you really want to look for a 15% return on equity. That allows for some reinvestment in the business while still allowing you to get the returns that you need. Now, this PE of 47.4 is actually very, very high. And so I have some concerns that this is going to be relatively overvalued. And it's not like it's only overvalued on PE ratio. You also have a very high price to book of 7.1, price to sales of almost 5. So all these numbers are very high. It's suggesting a level of overvaluation. It's going to take a little bit more work before we can say that it's truly overvalued. But that's what I'm seeing here. When we look at the earnings per share, then we want to see, okay, is something unique about this year? Well, 2021 of $1.84 per share is not way off the mark of what they've earned in the past. They earned that in 2016. They earned that in 2018. They earned less than that in 2019. So it's not like the drop from $2.52 to $1.84 is the complete driver for this. It looks like it's just you have two cyclical tops here in 2017 and 2020, which is marking these two high points here. But there's nothing abnormal about this earnings per share number like we should ignore it. Which means I would take this to be a relatively reasonable valuation here on this business of a 47 in terms of this being what it actually is trading at. I mean, maybe it's a little bit cheaper and it's at 35 or something if you were to take these other numbers. But either way, the price here is ridiculous. This company is clearly overvalued, and a lot's going to depend now on kind of like what the capital allocation policy is. So they are paying some dividends, but it looks like they weren't before 2018. That's okay. You can start up a dividend from a low amount. But even still, they're paying out 50% of their shares in dividends here and giving you a little bit of a yield. But that yield is like less than 1% based upon the current stock price. So you have 1% from your dividend, and then everything else has to come from revenue growth. Well, revenue growth of 10% is nice, but it's not exceptional. I mean, you need something a lot stronger than that. In addition, the fact that your EPS is growing slower than revenue is a little bit of a concern because there's no reason for that if you're managing your business well. So we're going to have to see what they're doing on the operating profit line because something's clearly not ramping up like it should. If you're enjoying this video so far, please hit that like button. Don't forget to subscribe, ring the bell icon so you can get notified as I upload new videos each and every week covering investing topics and companies like this as I work through every company in the S&P 500. Now let's go to the income statement. The income statement is going to tell us a little bit more information about the company. We see 10 straight years of gross profits, 10 straight years of operating profits, 10 straight years of positive net income. That's a good sign. Now, what's interesting to me, and is a little unexpected, is that you do have shares declining every year, which is a good sign. You see that, well, maybe not every year, but since 2013, you have been buying back shares, and they've dropped from about 342 million shares outstanding to 300 million shares outstanding. So about 12-15% decline in shares outstanding over the course of a decade. Not amazing, not great, but it is good. I like to see share buybacks more than I see dilution, so I'm happy with that. But my concern is maybe it's not declining as much as it should because the price is simply so high. Let's look at our balance sheet. Okay, so our PP&E has tripled. You've gone from 489 million to 1.7 billion. Assets have more than doubled, which is what we'd expect, right? Because the assets are growing pretty similar to revenue, so that's not abnormal. Let's see our debt. You go from basically no debt to begin the decade to $1.6 billion in debt, so you have basically used debt to completely add your PP&E. That's adding that little bit of leverage that you're getting on the business. Nothing wrong there, nothing out of the norm. Yeah, nothing wrong there. Let's see the cash flow statement. So you do have stock-based compensation, which is a little bit of concern. This is growing quite rapidly. It's grown 6x over the course of the decade. Part of that might be because as the share price has gone up, they're not cutting back on how many shares they're issuing. But so you're getting a lot of share-based compensation to employees. About 1/10 of the cash flow from operations is that cash stock-based compensation, but it's been going up. It's basically going up faster than the cash flow, so that's going to harm your return over time. Now they are buying back shares consistently. You see this net issuance of stock is negative, so they're buying back more stock than they are issuing, which you are getting, but part of that is funding, of course, maybe this executive or employee comp, and they're certainly taking a big chunk of that. You didn't have anything for dividends before this period, but you did start to pay some dividends now. They do have that net issuance of debt, and you can see this investment in intangibles. I don't know if that's R&D or what's going on there, or how they're choosing to classify that. You have a few acquisitions, but pretty consistent PP&E usage. Now, that's not taking up all of your investment. You're able to have some excess cash flow here, and they are seemingly putting it back into stock buybacks, but they're consistently doing some financing. I don't know. Some of this is all just mixed. There's nothing in here that makes this look like just amazing, but I do see a very large depreciation line here, and this is why the net income is so much lower than this cash flow from operations. You have the depreciation, 700 million, and you're putting in less than that. So you're investing less than you're depreciating, which lets me question is what is going on there? Are you actually becoming more efficient, or are you underinvesting in the future? If you're underinvesting, the returns are actually going to be bleaker than it shows here. Let's see, go back to overview. So this one's tough for me because what you see here is actually a really interesting business. You're having very strong return on invested capital. You have no losses, but there is some cyclicality here. This isn't stable. You go up in 2008, down in 2009, up in 2012, down in 2013, up in 2014, down in 2015, up in 2017, down to 2019. And that cyclicality is making it a little bit difficult to predict the future of the business. Now, you're growing revenue strongly, but I don't know why there's not a lot of operating leverage here. You should be able to have operating leverage. Your gross profit margins were 77% at the beginning of the decade, and you end the decade at 82%. And yet you began the decade with a 21% operating margin, and that's decreased over time to 10%, 12%. Why is your operating margin going down when you're growing? You should be getting operating leverage. And all I can think is basically we've grown the SG&A line rapidly, which is basically what's happened. You've tripled your SG&A, even though your gross profit has only a little bit doubled. So you're basically funding all of this excess into employees. You're funding a lot into research and development. Your employees are taking up a lot of the growth of this business, so maybe they're having to just be paid a very high amount. So that employee compensation is really drawing away what should be an absolutely amazing business here. No losses, very high gross profit margins, very strong returns, pretty good growth. But the fact that earnings per share is growing slower than revenue is what to me would make me avoid the company. I think it's got a great bones here, and if it was just managed a little stronger, I think you could have a very strong return in this company. So if there's any management changes, that'd be something I would look forward to maybe evaluating if they're going to make any big changes or turn around what they're doing here. So although the company is overvalued here, I would like the company to be at least half the price it is today, if not a lot lower, maybe 1/3 the price that it is today. I'm really more concerned about the way that the operating leverage has gone backwards. To me, this is a management issue, and a management issue really can't be addressed as an outside shareholder. So for me, I'm going to avoid the company. Thank you for listening. And until next time, stop paying fees, start building wealth. Don't forget to hit that like button and please subscribe.